As more companies grapple with sticky inflation and higher rates, investors have braced for downbeat earnings reports. But despite those bearish thoughts, earnings season is off to a solid start. Here with us now is Seema Shah, the Principal Asset Management's Chief Global Strategist. Seema, so how do you think the earnings season is going so far, actually? What's your assessment?
Well, I mean, looking at the recent tech earnings, it's going pretty well. But if you look at the broader economy, look at all the various sectors, after the collapse of SVB, you did see analysts really downgrade their earnings. So this is a fairly low hurdle to pass. So you have to look at it sector by sector, but resoundingly, mega cap tech is holding everything up. They're doing particularly well. I don't think that is actually that surprising. When you think about mega cap earnings, a lot of it is actually outside of the US. And you've already seen that European economy is fairly strong. China's reopening is a really, really significant part of this story as well. And typically, look, in this kind of environment, it's a big balance sheet. It's a strong cash flow, and it's the brand that typically will be performing well because they still have the pricing power.
But it's not just big tech. We've seen a lot of consumer-facing brands and public companies outperform thus far in the quarter. Does that give you a better indication about the macro?
Well, so I think when we look around at the moment, quite clearly things are fine, right? Consumers are doing really well, and that's been showing through in the earnings numbers. But it's still the case that the leading indicators are suggesting that further down the line, so not imminently, but further down the line, probably later 2023, is when you start to see a lot of the problems come to the surface. So I think, what we're hearing today is looking at the earnings numbers. This is a continuation of the very, very soft slowdown that had already been in place through 2022. But this is definitely not enough to break investor sentiment because, as you said, looking around, things look fairly strong.
But, okay, so you said a recession is still priced in for you. That's your base case. You talked to us a little bit offline about that. What's your prediction about how difficult the recession would be if it occurs by the end of the year, as you predict?
So we're expecting this to be fairly mild, right? What we've already seen so far is that the US economy is proving to be really resilient, and that has been upheld by a very tight labour market. So even as we expect the labour market to soften, we're not expecting unemployment rate to rise very, very drastically. So this is a recession which can be fairly rebounded from quite quickly. The Federal Reserve will have ample room to cut rates. So this is fairly soft, but we do see the action in motion, I guess. Fed rates gone up by 475 basis points in the space of 12 months. You have to let that lag come through. And at that point, activity is going to come down. But certainly right now, as you look around, it looks good. You just look under the surface to see some of that softness.
What is that indicator that you're watching that tells you the softness? Because we've heard the bond market's been flashing recession for how many quarters now? At least the last year.
Yeah, so the bond market is really key in this, as you said. So yield curve is telling us. If you look at a lot of the indicators coming out from the Federal Reserve, the New York Fed recession probability model is showing the highest probability of recession since 1980. And not only that, the only time it's been higher than it is today is when the US has already been in recession. But the bond market is typically very, very forward-looking. So you have to think about it. It's signaling, but it's not telling you it's going to happen imminently, but it's telling you that there is a leading lag. It's going to come through in a couple of months. Speaking
of forward-looking, the Fed meeting next week, what's your expectation for the Fed's next meeting?
A 25 basis point hike, I think, is fairly well priced in. Presuming that there is no further fallout, or I guess accelerated fallout from First Republic Bank, then I think we should expect to see a 25 basis point hike. So the real interest is going to be what does Powell indicate going forward from there.
All right. We have a lot more we'd love to cover with you. We'll certainly have you back. Seema Shah, our thanks to you.